For 45 years, ever since the Hunt brothers met their match in 1980, the global financial syndicate has had the silver market firmly in its grip. They assured everyone that the supply was inexhaustible, that silver was merely an industrial commodity, and urged them to divest at $30, then again at $50. However, on this day, Wednesday, December 10th, 2025, precisely at 9:30 in the morning Eastern Standard Time, the financial syndicate did something unprecedented in half a century. They capitulated. Observe your displays. Silver is currently trading at $61.75. This figure represents more than a mere price point. It's the scene of a significant financial transgression, the audible implosion of billions in uncovered short positions occurring in real time. It signifies the dawning realization for behemoths like Bank of America, JP Morgan, and their ilk that the era of speculative paper trading has concluded. The $60 psychological barrier, their Maginot Line, has been breached. Beyond this threshold lies not a point of resistance, but rather a graveyard for financial institutions and a promised land for the resolute. The mainstream media will undoubtedly characterize this event as a market squeeze or a speculative bubble, attributing blame to online communities, international demand, or even you, the viewer. Yet you understand the fundamental truth. This is not a bubble, but an escape from confinement. For 4 decades, the price of silver was artificially suppressed, forbidden from reflecting its true value. Now, it is finally articulating an undeniable reality. Over the next 30 minutes, I intend to meticulously dissect the collapse of what may be the most monumental short squeeze in human history. I will meticulously detail the financial losses incurred by these institutions with every single cent the price ascends. I will elucidate the critical failure of commercial signals, the definitive technical indicator confirming the loss of control by market manipulators. Furthermore, I will demonstrate why $61.75 is not the apex, but merely the starting gun for an anticipated ascent to $100 for those who have maintained their holdings. If you are one of the individuals who acquired silver while others ridiculed your foresight, or who purchased when prices were artificially depressed, this presentation is for you. Allow yourself a moment of triumph, for the financial titans have just lost a decisive battle. To fully grasp the significance of today's events, one must comprehend the symbolic weight of $60. In the annals of military strategy, the Maginot Line was a series of French fortifications designed to deter German aggression, envisioned as an impenetrable defense. For the bullion banks, $60 served a similar purpose. The rationale was rooted in the fundamental mechanics of the derivatives market. Exceeding $60 destabilized their carefully constructed financial models. These institutions don't simply trade silver. They trade contracts, each typically representing 5,000 ounces. When a bank engages in short selling, it commits to delivering a specific quantity of silver at a future date for a predetermined price, a commitment that can span years. In the past, whenever silver approached $30 or $50, these banks would issue millions of such contracts. They would essentially generate synthetic silver, flooding the market with phantom supply to instill fear in buyers and drive down prices. This tactic proved effective in 2011 and again during the silver surge of 2021. However, this strategy's efficacy hinged entirely on cultivating an atmosphere of fear. The Silver Institute reported a deficit of 237,700,000 ounces in 2023, followed by another 140 million ounces in 2024. The deficit widened further to 215,300,000 ounces in 2024. And as we conclude the financial year of 2025, preliminary projections indicate a further depletion of nearly 200 million ounces. Cumulatively, since the commencement of this decade, we have experienced a structural deficit approaching 800 million ounces. This calculation, however, excludes the impact of investment withdrawals, such as silver being transferred from exchange-traded funds into private vaults. When factoring in the diminished reserves within London Bullion Market Association vaults, which have shrunk by 30% from their 2021 peak, and the widespread phenomenon of retail silver accumulation, the true deficit escalates beyond 800 million ounces to over 1.1 billion ounces. Consider the implications. The global mining industry produces approximately 830 million ounces annually. This means that over the past 5 years, we have consumed more silver than an entire year's worth of global production. From whence did this surplus silver originate? It was drawn from dormant inventories, from the vast quantities held in London vaults, representing legacy stockpiles from the 1990s and government reserves. We have effectively been depleting our reserves to meet daily demands. The financial syndicate thrived on this practice, able to point to these substantial vault holdings as evidence of ample supply, thus discrediting any notion of a shortage. Yet fundamental economic principles are irrefutable. A deficit cannot persist indefinitely. Eventually, the reserves are exhausted. This is precisely what transpired this past week, leading to the breach of $59. The phantom silver has been depleted. The available silver for lease within the LBMA's purview has effectively reached zero. Registered inventory levels are critically low. Consequently, every new solar panel, every advanced missile system, and every new smartphone manufactured henceforth must be constructed with silver mined in the immediate present. There is no longer a buffer, no emergency reserve. In a market characterized by inelastic demand, where consumption is largely independent of price, the absence of a supply buffer does not result in a gradual price adjustment. Instead, it triggers a vertical ascent. The 1.1 billion ounces did not simply evaporate. They represented the anchor tethering the balloon, and that tether has now snapped. However, skeptics contend that if silver reaches $60 or $80, demand will inevitably contract. They postulate that solar manufacturers will transition to copper or reduce their silver consumption. This assertion represents the most significant falsehood currently circulating on Wall Street, and I intend to debunk it using a single acronym: TOPCon. For years, the solar industry relied on a technology known as PERC, which, while sufficiently efficient, utilized approximately 10 milligrams of silver per watt. However, PERC technology reached its inherent limitations in terms of further efficiency gains. In the energy sector, efficiency is paramount. Consequently, the industry underwent a significant transformation, shifting in 2023 and 2024 to TOPCon and heterojunction (HJT) solar cells across the entire global manufacturing landscape. Herein lies the critical juncture. The holders of silver contracts, the longs, sense opportunity and are unlikely to sell at $61, anticipating a price of $70. This forces the banks to bid higher, engaging in a bidding war against themselves and other distressed institutions. This phenomenon is known as a short covering rally, characterized by some of the most aggressive price movements in financial markets, driven by a primal need for survival rather than by underlying fundamental factors. Bank of America stands out as a particularly significant player in this scenario. According to reports from the Office of the Comptroller of the Currency, in 2024, Bank of America had substantially expanded its holdings in precious metals derivatives. They had effectively become the lender of last resort, absorbing short positions that other institutions, like JP Morgan, sought to offload. Today, Bank of America faces an existential crisis. At $61 or $75, their derivatives portfolio represents a ticking time bomb, necessitating immediate coverage. Their forced purchases are precisely what will propel the price to $70 by Friday. This is the anatomy of a default. The speculative leverage that suppressed prices for decades has now reversed its trajectory, transforming from a downward force into a powerful upward catalyst. For traders paying close attention to technical indicators, we have just witnessed a critical failure in commercial market signals. For 40 years, the pattern was remarkably consistent. Silver prices would rise, banks would increase their short positions, prices would subsequently crash, and this cycle would repeat ad infinitum, functioning as a perpetual profit-generating machine for trading desks. However, the data from the preceding 2 weeks reveals a stark deviation. As silver climbed from $55 to $60, banks did not augment their short positions. In fact, open interest declined. This signifies a profound shift. They have ceased their resistance, acknowledging their inability to counter the overwhelming influx of demand originating from the East. This constitutes a critical signal failure, indicating that the established price management mechanism has been deactivated. The underlying cause for this development is the Basel III net stable funding ratio. This regulatory framework, discussed years ago, is now having a tangible impact. The new banking regulations impose significant costs on financial institutions for holding unallocated paper gold and silver liabilities, necessitating physical backing. However, this physical backing is now critically scarce. Consequently, compliance departments within these banks have instructed their trading divisions to liquidate positions, as they can no longer bear the escalating capital charges. Thus, these institutions are not merely incurring losses on their trades, they are being compelled by regulatory mandates to exit these positions. They are becoming forced buyers in a market with virtually no available inventory. This is precisely why $61.75 represents a pivotal moment, distinct from the $50 seen in 2011. In 2011, banks actively fought to suppress prices. In 2025, they are desperately attempting to extricate themselves from a collapsing market. When the manipulator transforms into a buyer, the price ceiling effectively vanishes. Why? Because the major players in India anticipated the impending deficit, recognizing the substantial demand for pace required by the burgeoning solar factories in Gujarat and the strategic emergence of GIFT City as a challenger to Western financial hubs. They strategically acquired silver at lower price points, even when it hovered around $22 or $24, effectively clearing out London's vaults while the LBMA was seemingly disengaged. Now, as silver approaches $59, one might surmise that India would initiate sales to realize profits. This is a miscalculation. In India, silver is not merely a trading asset. It represents accumulated wealth, often referred to as the poor man's gold, and simultaneously serves as a vital industrial input for the affluent. The silver that has flowed into India is not destined for return. It has been transformed into jewelry or consumed in electronics manufacturing, thereby exiting the speculative market. This is the crucial element of the 1.1 billion ounce deficit narrative. This silver has not disappeared. It has transitioned from less committed hands to those with a long-term perspective. The West is now confronting a tangible shortage, realizing they divested their financial insurance to the East at significantly undervalued prices. JP Morgan, with its sophisticated market tracking capabilities, is acutely aware of this trend. They observed the outflow of 73 million ounces in February 2024 and the subsequent departure of thousands of tons throughout 2025. This explains the cessation of their short-selling activities and the diminished effectiveness of previous price suppression tactics. It is impossible to manipulate a market devoid of physical metal, or to engineer a flash crash when India stands ready to absorb every downturn. The significant acquisitions by Indian entities have effectively broken the back of the short sellers, compelling the West to incur substantial costs to reacquire any physical silver. We are now at December 9, 2025, with silver at $59. What lies ahead? We are entering a period of vacuum. In technical analysis, resistance levels are formed by individuals positioned to sell. For example, someone who purchased silver at $30 5 years ago might be inclined to sell at that same price to break even, thus creating resistance. However, who has purchased silver at $65, $75, or $85? Essentially, no one. There is no impending overhead supply, no cohort of holders eager to divest at a loss. From a technical standpoint, this signifies an unhindered ascent, a phenomenon known as a blue sky breakout. When an asset surpasses its previous all-time high, it enters a phase where price discovery is driven upward, as sellers can only be located by bidding higher. We witnessed this with Bitcoin, which surged from $20,000 to $60,000 within months after breaking its previous high. Similarly, Nvidia experienced a dramatic ascent. Now it is silver's turn. However, there is another significant target, one directly indicated by the 1.1 billion ounce deficit. $100. Is $100 simply a round number? Not entirely. If we adjust the 1980 peak of $50 for inflation, utilizing the government's own manipulated consumer price index figures, that $50 value would equate to approximately $170 today. Therefore, at $59, silver remains historically undervalued, still approximately 60% below its real all-time high. Psychologically, however, $100 acts as a powerful magnet. The vacuum effect operates in stages. Firstly, short positions are covered. Hedge funds still holding short positions are compelled to purchase silver to close their trades, prioritizing survival over price considerations. Secondly, the fear of missing out, FOMO phenomenon, kicks in. Retail investors who overlooked silver at $25 now witness it at $60 on the news and rush to acquire it. Thirdly, industrial panic ensues. This is the most significant driver. When major corporations like Tesla and Samsung realize that the 1.1 billion ounce buffer has been exhausted, they transition from cautious purchasing to proactive acquisition, engaging in hoarding. This hoarding behavior exacerbates scarcity, which in turn drives prices higher. Elevated prices then trigger further hoarding, creating a self-reinforcing cycle that is devastating for financial institutions, but immensely beneficial for physical silver owners. The disappearance of the 1.1 billion ounces has created the conditions for this vacuum, and natural forces abhor a vacuum. Price will inevitably surge to fill it. I anticipate a rapid escalation from $59 to $75 before the end of the current year. Furthermore, $100 is not a target for 2030. It is a realistic projection for 2026. The 1.1 billion ounce deficit was not an accidental occurrence, but rather a deliberate transfer of wealth, moving from the impatient to the patient, from those who believed in paper assets to those who recognized tangible value, and from the West to the East. For 5 years, the data provided clear warnings. The Silver Institute reports were publicly accessible, LBMA vault data was readily available, and Indian import figures were transparent. Everyone had the opportunity to observe the growing deficit and to acquire silver at prices of $22, $25, or $30. However, most individuals deferred to the pronouncements of television personalities and financial institutions. Now the buffer has been depleted, the $59 support level has been breached, and the vacuum is actively drawing prices upward. If you are currently viewing this and still hold unallocated paper silver accounts, such as SLV or pooled allocated accounts, you are essentially standing within a burning structure, placing your faith in the solvency of an insurance provider. Acquire physical metal if it remains accessible, because the 1.1 billion ounces that vanished will never return, and the acquisition of the subsequent billion ounces will undoubtedly incur a significantly higher cost than $59. The squeeze is not imminent, the squeeze is already upon us. I will see you at $100. Subscribe.